Well, a warm welcome to everyone, and thank you for joining us today. My name's Carty from Solace Financial, which is a locally owned and locally staffed firm here in Brisbane. Today we have Nick Cregan from Fairlight Asset Management. Nick's a partner at Fairlight Asset Management, serving as the portfolio manager in the investment team since inception of the fund in 2018. Nick has over 20 years of investment experience in the domestic, US and international markets. Prior to forming Fairlight, Nicholas served as a portfolio manager at Evans and Partners and at Schroeder Investment Management, where he held a senior analyst and portfolio manager position in New York and Sydney respectively. But before we get stuck into today's discussion, we'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your objectives, your financial situation or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Also, refer to a product disclosure statement regarding the product for further information. Details of this general advice warning can be found at the moneysmart.gov.au website.
So thanks for joining me today, Nick. As a fund manager specialising in the global small and mid-cap fund space, can you talk us through Fairlight's history and investment philosophy?
Sure. So Fairlight kicked off as a business in 2017, and that was a culmination of all my experiences going back to the early 2000s working as a sell-side analyst at JP Morgan. I spent more than a decade with Schroders, both here in Australia and offshore in New York. Came back and had a stint running the international fund alongside Stephen Arnold, who's now at Authorised. And then after that experience, so those three sort of culminating experiences, a combination of my small cap experience and international experience, launched Fairlight Asset Management. The unit trust opened in 2018. We've got a team of 5, and it's an incredibly flat structure at Fairlight, so everyone makes a huge contribution.
Right, okay. And can you talk us through the investment process you use?
Sure. We take some 5,300 stocks that are available to us in the small and mid cap index, and we apply a number of filters to that index to whittle it down to an opportunity set of 200 to 300 companies. And the way that we sort of think about that is what we're trying to do is screen for the highest quality businesses, the most profitable businesses, the most resilient businesses within our index. And from that subset, we're trying to eke out areas where we think we can find some alpha. And so we move from what we'd call speed through diligence. So we've got the screening process, then we have rapid due diligence up front, which is more than a 2 or 3 day research effort where we bring that idea to the team. We all sit down, scrub that idea down together. And then if that idea looks like it could be a Fairlight stock, that's when we're employing a huge amount of resource to the due diligence effort, often having an analyst, or in our case, we call them PMs. We don't really care for titles too much, so call us whatever you like. We've got one of our members of the team based in London or New York for 6 months of the year. I'm just gearing myself up for a 3-month trip next year. We get good density of meetings through that process, and then we've built some custom software that houses all of our qualitative and quantitative information, which allows us to debate those stocks digitally, much like we are now if we're offshore or together as a team, if we're in the same room. And then we move through to the stock selection process, or the portfolio management process, whereby everyone is expected to have a very strong opinion about what's going on across all of the businesses in the portfolio, not just those ones under their own coverage. And I'm the final decision maker, just to make sure we don't get paralysis by analysis. But I see myself more as a coach than a dictator. I can assure you that the other members of the team are very, very capable investors in their own right. And through that process, we come to a portfolio of some 30 to 40 of the best small and mid-cap companies in the world.
What differentiates a small and mid-cap fund from a large cap fund?
Yeah, I think this is definitely the misunderstanding, I think, from an Australian's point of view, and it's completely understandable to see where this misconception has come from. A mid cap in the US is now defined up to $40 billion in market cap.
Wow.
So it's not unusual for active managers such as Fairlight. The weighted average market cap across our fund is actually $15 billion. So sometimes people think, oh, small and mid caps, God, they must be riskier than my large cap holdings, etc. If you feel comfortable with some of Australia's largest businesses, so a ResMed, for instance, or a Cochlear, you'll be fine with some of the holdings that Fairlight invests in. So we invest up from $1 billion up to $40 billion in market cap. mid-cap, but we did not have to sell a stock if it moves through that $40 billion barrier. If we've got the next Microsoft on our hands, the world's worst reason for having to sell is for a definition of a mid-cap. So we limit ourselves to our purchases in the smaller mid-cap market, but we aren't limited to how long we can hold those securities for.
Right, okay. And how do you assess risk when you make your investment decisions?
Well, the funny thing about risk is the academics define it as sort of volatility, and I think that really came about because that's really mathematically the only thing you can measure. And we all know that in finance we love putting really funky and impressive looking equations together, but at the end of the day, it doesn't really tell you much about your long-term investment outcomes. So volatility can be high, volatility can be low, but what we're really trying to assess is the permanent loss of capital or the riskiness of that business and and the chances of us essentially being wrong. And so what we're always doing from an assessment point of view is a bottom-up analysis of all of our businesses to really derive exactly how resilient they are, not only today, but during a cycle. And so much to the chagrin of my team, unfortunately, I was managing money during the great GFC in 08-09, and I was managing a small and micro-cap fund on behalf of Schroders, and that experience is seared into my brain. So we always model our businesses back to 2006 to see how they went through that period, and what we're really looking for are those companies that did well. So to give you a view, whilst we weren't managing the current portfolio back then, around 85% of our companies were listed during the GFC, and not a single one of those companies made a loss or had to raise any capital. So that's the kind of assessment we do on risk. We don't like highly levered businesses. We don't like companies that are particularly cyclical. We don't like single points of failure or spots where we can sort of get tapped out from a single customer or a single product. So our assessment of risk is very fundamental. And yes, we prefer lower volatility if it comes with an equal return. So we'd much prefer a higher volatility 30% return than a low volatility 10% return. But if we have two 15% returns, then we'd prefer a lower volatility way of getting there.
Okay. What are the opportunities and risks that you see out there at the moment in the current marketplace?
Well, the greatest source of opportunities at the moment are those parts of the markets that have really been left behind, and then it really comes down to a little bit of sentiment. So in the US, so we invest all of our capital offshore, so not a single dime here in Australia and New Zealand. We love Australia and New Zealand, but you've got great managers here already doing a fantastic job for you. You don't need us doubling down on that. So around 55% by revenue of our portfolios based in the US, and then a big skew to Europe and the UK, and a spattering through developed Asia. We're not in emerging markets at all. So when we kind of think of the opportunity set, the big ones for us at the moment are what's happening in US housing, sort of this sense that US consumers are locked into their housing for the next 50 years because of very low interest rates. And unlike Australia, unfortunately for us, unlike Australia, you can lock in 2.5% money a few years ago for your mortgage, and that makes it very, very difficult to move houses because you reset your mortgage rate to the prevailing rates, etc. So what that's meant is a sort of some of the housing stocks trading at very depressed multiples, and we think that's a little bit unwarranted. And the consumer has been coming under a lot of pressure as well due to inflation. So there's some high quality consumer stocks. We've got a very low exposure to consumer generally, but those businesses are looking quite attractive. And then within the technology space, where there's a lot of hype, as we all know, about what's happening with artificial intelligence and machine learning, and we're on board with the idea that they are indeed transformational technologies, you can get exposure to that theme through what we call value-added resellers or consultancies, where you don't have to pay 50 to 100 times earnings. You can get in those businesses on much more reasonable multiples. So there's a few sort of snapshots of the opportunity set. There's many, many more. On the risk side, we don't spend a lot of time thinking about geopolitical risk. I don't know about you, Joel, but I've predicted about 30 of the last 2 recessions, so I've given up on that. I just try and buy really resilient companies and let them compound out over a long period of time, because your hit rate on trying to do that, even the best in the world, the Druckenmillers and the Soros, etc., they do get it wrong pretty often. So let's not kid ourselves that we're going to do any better.
Exactly.
But we do keep an eye on sort of the big geopolitical risks around the world. It's not going to be a lot of fun if there's a kinetic war between China and Taiwan. That's not going to do great things to the supply chain on chips. We saw that during COVID. That was a big deal. So that's a bit of a left field thing that might come through. More pressingly, I think, is really what's going to be happening in the US from a cyclical point of view. whilst it does look like a bit of a softer landing, the conversation's moved from a outright recession to a softer landing. We do look at the statistics of the US Federal Reserve engineering a soft landing, and they're not great. But we like to think at the moment there aren't really any massive signs of recession here. Employment markets are softening, which we want because we want inflation to come down. If that turns into something more sort of worrisome, that might be problematic. But as it stands at the moment, reporting season was fine. More companies beat it in this reporting season than the last 5-year average. So, touch wood, but things are looking okay, and valuations in the small and mid cap market are also looking pretty attractive. So they put those two things together, and at the moment, pretty sanguine on the outlook.
Okay. Now, how would you describe Fairlight's greatest strengths as a fund manager?
I think it's a couple of things. An incredibly flat structure is the first thing. I kind of thought through my career of, all the experiences I've had and, what was good and what was bad about those things. And I think that sometimes you're frustrated as a young analyst that you've got some ideas or you see a risk and, it's difficult to voice that amongst senior people. So I do my best, and maybe I'm not perfect, but I certainly do my best, and as does the other sort of senior members of the team, to make sure that the most junior members are heard. And by the way, it's the younger people that are going to have far more insight into things like technology than you are. So you've got to keep a very open mind to that. So we keep the structure as flat as possible. We've all got the same title. We all work in exactly the same way. We still have to present stocks in the same way. I present stocks to the team in exactly the same way as everyone else. So keep that structure nice and flat. And I think that speaks volumes to the culture. Secondly, a small team. So sometimes people say, look, surely a team of 12 or 15 people are going to outperform. If you look at the mathematics on the communication nodes of that, it becomes pretty unruly. So once you've got 12 members of a team, you're now then managing 66 communication links between all those members. So I'd put it to you that you're now an HR manager and not an investor at that point. So I think a small team, flat structure, keeps things incredibly efficient. And on that basis, we've built some pretty amazing technology in collaboration with our tech partner, Calibre, that stores all of that information. And that's, quite frankly, work that we tried to get done at much bigger institutions and couldn't because of bureaucracy. And the last thing I think is just keeping very, very open-minded about where we might be wrong. And so there's a trade-off there between knowing when you should have conviction and knowing when information is doing damage to the original investment thesis. And if that's the case, being very, very open-minded that maybe that capital could be recycled elsewhere at a much more rapid pace. So I think I'm putting all those things together sort of leaves us in a pretty good spot to drive good outcomes for investors.
Oh, brilliant. And can you talk us through a time when you've turned a period of poor returns into an investment opportunity and turned the overall performance around?
Sure. So we've outperformed in 4 of the last 5 years. The year that we did suffer a little bit was in 2022. So you'll recall that was a period of sort of peak inflation, I guess you'd call it. And investors were very interested in what they perceived to be inflation hedges. So commodities, oil and gas, and all these sort of more, I guess you'd call them material type businesses, ripped pretty hard. Fairlight, as you know, don't invest in those less predictable parts of the market. And so we got left behind fairly significantly over that time. In fact, it was the first year in about 30 years where the quality style of investing underperformed the market in a down market. So that wasn't much fun. The good news, though, was that it was almost indiscriminate. And so we had this opportunity as securities got sold off to really upweight the quality of the portfolio. Anything that we thought had a sniff that, might not be tracking as we expected it to, or the quality of the business was in maybe the lower 10 or 20% of the portfolio, we were able to sell those securities at not too much of a penalty, quite frankly, and shift them into other businesses in the portfolio and sort of come out of that period with what we thought was a higher quality portfolio. Now, I'm not talking 70% turnover of the portfolio here. It was more like 30%, 35%. Just making those incremental changes from a position of almost strength because there was no cost of doing so on a relative basis. What that meant was very, very strong outperformance during 2023. It was done in a really calm, measured way. Again, the team did an exceptional job, and LBC and Will in particular on some of their businesses, they did a fantastic job. So from a team perspective, I was incredibly proud of the guys and girls that they were able to deliver exactly what we put on the tin, which is buying quality businesses, especially during periods of distress.
Okay. Well, carrying on from changes to the portfolio, what are some of the changes you've made recently?
There's been a few businesses. The three that come to mind. The first one is MSCI. So that's a index provider. Spun out of Morgan Stanley back in the 1990s. It's an incredible business in a couple of ways, and we feel the strength of their business model very succinctly at Fairlight. I can tell you because we use them for our index that we provide to investors to check our performance and to calculate against our performance fee. So what that means for Fairlight specifically is that it's almost impossible now for us to shift service providers. So MSCI has very strong pricing power across the market. So during COVID, when costs were up and they put their bill up fairly substantially, we gulped and said, thank you very much, but we're still paying the bill. And so that sort of pricing powers and sort of inbuilt switching cost for clients is kind of what we're looking for in our businesses. So we could either whinge about that or buy some of the equity. And the business had derated from a point where the valuation looked quite attractive. So we actually owned it back in 2018, sold it in 2021 as valuation became untenable. And then as won't get into the details, but their ESG franchise slowed a bit. The multiple retraced, and we thought that was a very attractive re-entry point. So we've repurchased that business. The next one is Pool Corp, and who would have thought the distribution of pool chemicals would be one of the best compounders in history? So that business has generated 25% compound return since 1994. It's quite extraordinary. It's extraordinary. And it's a business that it services the pro market. So it's not like you'd use Pool Corp to rock up and buy a few pool chemicals for your backyard pool. It's really for the pro that that pool service is outsourced most of the time. Certainly, I've recently bought my first family house and we've got a pool in the backyard. I quite frankly don't really know what that bill looks like. I know it's a few $100, but if they put it up by 10% next year, I wouldn't flinch. And so it's that sort of small ticket critical service that you don't really shop around too much. And so for the pool, the pool professional, he needs to get his chemicals and his equipment from somewhere, and that's where Pool Corp comes in. They've got an amazing distribution network where they're aggregating all of the requirements for a pool, whether it's maintenance or new build. And on the other side of that, they're distributing that to the pros who see that service is critical to them as long as it's delivered in a just-in-time basis. The Pool Corp's been rolling up that industry for the best part of 30 years. It's a very dominant position, and at the moment we've bought it on sort of all-time low PE multiples, and we're quite happy with that acquisition so far.
Brilliant. What's a PE on that at the moment?
It's low 20s. It usually trades at a much higher multiple to that. But the other element to it is if you sort of adjust for the cycle, it's under earning as well, pretty substantially. So if you went through the cycle sort of PE on that business, it's actually much lower than that. The reason for that is about 60% of their business is truly maintenance. So that's really just people rocking up and servicing your pool and making sure everything's running as it should be. There's another 20% which is renovation and repair, and that's been a little slower than normal. So the average age of a pool, where you should be sort of updating your pool every 10 to 12 years, but the average age of a pool in the United States is 23 years. So there's sort of a pent-up demand for refurbishment of pools. But the big sort of element and what's been weighing on the stock is essentially the new construction. So about 20% of their revenue comes from building new houses, pools go in, et cetera, and we're approaching GFC type levels on new housing construction. So less about saying, look, the other parts of the business are doing incredibly well. It's more about saying, well, it's difficult to see how we lose money from here, given where we are on new pool starts. And we sort of forecast out 5 years or so. Any sort of recovery in that new housing part of the market is going to be a real tailwind to Pool Corp.
Okay. Now, how do you stay up to date with all the changes that are occurring in financial markets?
Yeah, for us, it's a little less about sort of looking at financial markets and reading the tea leaves and, looking at the minutes of the Federal Reserve and all that sort of stuff. We keep up with that stuff and we read about it. I find it personally interesting, and I can talk about macro with clients because they find it interesting as well, but it's not really how we spend our time. 99% of our time is spent looking at businesses, how they work, speaking with the management teams of those businesses, understanding the competitors, whether there's new competitors coming into the market, who's winning and losing share. And we limit ourselves to those companies that are a little bit more sheltered or resilient versus the cycle, because we aren't macro predictors, and we don't kid ourselves that we are. And so we're looking for those businesses that have got slightly more muted cycles. And then if we can see these businesses are becoming stronger and more competitive, their moats are becoming wider on a year-on-year basis, that's really what we're looking for. So my days are typically spent, I just got off a call right before this morning with a company called Jack Henry. It's a provider of core banking software in the United States with their CFO. Tonight I'll be speaking to some businesses in Europe, and I spend the middle of my day doing research, reading transcripts, journaling information from industries, speaking to professional or expert networks where I can, et cetera, and we bookend our days with calls to management teams on the back of those. We also do a lot of travel, and so if we're not offshore for 6 months of the year, we do shorter trips. So I'm due up in the States in the beginning of November for a couple of weeks, where I'll be going East Coast and mid-US, visiting a bunch of businesses, and through those conversations, we kind of glean what's happening in their respective industries. So it's really about sort of putting this mosaic of information together into our portal, which we'd love to demonstrate to your clients at some point. All of the qualitative and quantitative information gets stored into that, and that gives us the basis to debate that amongst the team in a very, very flat and open forum.
That sounds pretty impressive. Now, Nick, last question. What makes a good portfolio manager?
Well, that's a really difficult question to answer, because it's almost like what is a good portfolio manager within the culture that they've built, and what kind of works for them. I think there's a few things that a few tenets that from the outset are important for anybody. I think the first one is going to be open-mindedness, just the sense of, I don't have all the answers, I'm going to be wrong often, so let's make sure that we figure out when we're wrong and course correct as quickly as possible. So that's a huge part of it. I think the second element is almost the flip side to that, is almost a little sense of grit or determination, and that sort of comes during periods of downturns, or when the pressure's kind of on in financial markets, or you've got a stock that's under pressure from a share price point of view, but your thesis looks like it's intact. Do you have the courage to step in and buy stock? So there's two elements, which is open-mindedness, but also a sense of conviction where you think you are right is very, very important. The third thing is just a real sense of curiosity and a sense of, look, there's so much information out there in the world. How much of it can I absorb personally? Trying to do that in the most efficient way possible is really important. Being able to store that information in a way that's useful is really, really important. And then depending on the culture that you're trying to create, that's where the personality traits come in. And so for me personally, I like the idea of working within a team and a true team experience, trying to help each other and coach each other in sort of different areas. Some other people kind of like the idea of being the key decision maker, and that's kind of it. And you've got a team built below you to kind of feed information to you. I kind of like being amongst the team, which is a bit different, and that means often other members of the team, their stocks are going to be the biggest positions in the portfolio. I think that is wonderful, and as it should be, as people develop and you get to see their thought processes and you share ideas. I don't think you should have an ego about sort of how that capital's split amongst the team. And for us, our incentives are set up similarly, so we get paid a base salary. There's no short-term bonuses, and we do well when our clients do well due to the dividends that's paid by our business rather than short-term incentives. So what that means for us is that there's no sort of sense of jockeying for position or trying to push ideas where they don't make sense. And I think that sort of having that really open culture for us anyway works really nicely.
Okay. Now, Nick, I appreciate you making the time to talk to me today. Is there anything else that you'd like to add that we haven't already discussed?
Not really. I mean, the only thing I would just sort of point out here is that with the advent of new technologies coming into the market, we are firm proponents that is going to be a tailwind to the way that Fairlight does their work. And so we've been sort of uploading information to our system now for 7 years, and some of the new techniques that we're seeing and we're all reading about, we're at the early stages of implementing that across our strategies. So we're completely au fait with the idea that this technology's AI and machine learning is going to be world beating, but at the same time, I think it's important to keep your feet firmly on the ground and to realise that there's going to be some bloodbaths along the way, making sure you don't get caught up in the hype. So it's a open-mindedness to how the world's changing, but not paying silly multiples to get exposure to that sort of thing. That's really how Fairlight's been investing for the past 7 years or so.
Okay. Thanks again, Nick. I appreciate it.
Absolute pleasure. Thanks so much for having me on, Joel. I really appreciate it.
Thanks.